Now, there are four types of firms we are going to discuss. First is the sole proprietors. Well, in order to start, maybe it's easy for us to start for the sole proprietor compared with the other because it's really very straightforward. So this is one of the advantage of that, and the second advantage is that it has well, it's not really advantage, but there is a no separation between the firm and the owner, so that makes that if there are some investors in that business, they have no ownership with that particular business. And the third one, owner is not secure when it comes to liability of the business because the creditors can take up to their personal assets of the owner. It's not only limited to their to the assets that are invested in the business. And the fourth is that the life of the business is limited only to the life of the owner. So once the owner dies, so also the business dissolved. But also, of course, it can be carried with the other owner. So they say that the disadvantage of the sole proprietorship outweigh the advantage, as you can see, as discussed earlier. So what's in here is that it shows in figure 1.1 are the four major types under pie graph in terms of the share in the total business in the US. So it shows here that um, in the corporation for the total that 85% of all the businesses are corporations, and of course we are going to discuss the advantage of why people are choosing corporations over the other. And in here in terms of percentage of businesses, the sole proprietorship is 71%. It's because it's easy for them. Corporation is more formal and there's a need for that. But in terms of the revenue, it's composed of 85% total sales over all of the business are owned by the corporation. Partnerships is the second form, but it's like extended form of the sole proprietorship because when it comes to the liability, it has no limitation. The creditors of the partners or the partnership can go after any of the partners of the partnership. So that's why their personal assets can be also can be used for the settlement. And the partnership or any withdrawal or death of any partners can be dissolved. However, they can avoid the liquidation if they have some agreement. Like for instance, if the partner is withdrawal, it can be both out by the other partner who wants to stay in the business. Now, as the time goes by, there is what they call the limited partnership. It means to say that partnerships are only limited to their liability to the extent of what they have invested in the partnership. So this is another form. Okay, so it's that's different from the limited liabilities companies. Limited liability company or LLC is not the same as the limited partnership. Limited partnership are only in general, they are not liable to the extent of the personal assets to partners for those partners that are limited in terms of the liability because in the limited partnership there must be a general partner or the managing partner who is liable even to the extent of his or her personal assets. For this LLC, limited liability company, the all of the members of this is not really liable. They are only the liability is limited only to the assets possessed by the partnership. Okay, so in the corporation, this is different from the limited liability companies because of there is a legal definition. So it is called as another artificial being, okay, separate from its owners, meaning to say that if you're investor or you're the owner of the corporation, by legal terms, you are legally separated. You're not the same as your corporation. So because of its legal identity, it can enter as a legal entity. Like it can enter into contracts with the suppliers, customers, hiring some employees like that as a separate person. So it can be sued or it can sue as a legal separate. So in setting up a corporation, there is a legal forms and some documentation that you need to follow, and it might be costly compared with the sole proprietors. So there's a need for the other to have a lawyer in order to form some corporate charter, including the articles of incorporation. Okay, so um, in ownership of the corporation, this is different because the ownership will be expressed in terms of stocks. Like if you want to own partly owner of the corporation, you need to buy stocks out of that. So there are a number of stockholders in order to start in this, but they have this actually a sole proprietor, like a sole corporation actually now. However, most commonly there are a lot of stockholders that are like I think 15 is the at least initial owners of the corporation, like some subscribers of the stocks. And yeah, and also the extent of your interest or your control over the corporation will depend upon the number of stocks in terms of percentage of the whole. Let's say out of the 1,000 stocks you own 60% of that, which means to say that you own 600. It means to say that you have some control over the company. Whatever you decide, since you have a vote, because the vote is equivalent to to the number of stocks that you're owning. So therefore, out of the 1,000, since you have the majority of the votes, so therefore you have the say over the company. Now, some of the formed corporations is that what I mean, in some situation of the corporation, they have this like some are having less than 50%, so they have no control. Like the other having 40, while the other is 40, then the rest are 20. So it's like that he cannot dictate about the policy making of the corporation because he has no control over the corporation. Now, now the stocks will serve also as a measurement on how much dividend are you going to receive as one of the stockholders, which depend upon your stocks and the amount of dividend that are declared in per stock. And the dividends could be in the cash form or in the stock or in the property form or a bonds payable form or in the notes. Those are the form. And the dividends are not automatically declared. It depends upon when the management of the corporation is declaring it. The earnings that can be um, reaped by an investor stockholders is the dividend is one way of doing that, receiving the cash flow. However, there is another one way of reaping your investment, the return of that, by selling your shares of stocks at a profitable price. Let's say you buy the stocks at 100 per share, $100 per share. Now, after a few years, it became 180 per share. Now you are now gaining 80 out of your 100 that you have invested, and how are you going to convert it into cash? Now the 180 value is dictated by the market. It means to say that your 180 is the price that is what the market is accepting. So in other words, if you're going to sell your stocks at 180, the 180 is realizable automatically. So you can gain the 80 dollar automatic as your gain out of that. So you don't need to wait for the dividend in order to reap your profit up out of your investment. So that's the beauty of the finance. The investors of the corporation will entrust their funds to the financial manager or the CEO who will do that. So based on their decision making, it will turn the value of their investment into more or higher value, which would be dictated by the market. So how do they do that? So they make sure that the funds that they are managing is that they invested it in a correct way or in a more profitable projects or business in order so that if that particular decision making are found to be more beneficial in the eyes of the market, so the reaction of the market is actually will be in the positive way, is that they're looking into the future. If you're doing this right now and they see that in the future the project is more profitable, it will gain more profits than ever, so therefore they are going to buy your stocks at, at a reasonable price. It is dictated actually as like a demand and supply. So meaning to say, if there are I mean limited available stocks in the market and your stocks are really interesting because of decisions made or the activities made by your financial managers, so it will turn your stocks into a higher price. So that the increase of the stock price begins, and that if you are existing investors of the corporation, then you are going to start reaping your the value of your investment, or I mean the earnings of your investment, by the increased number by the increased value of the stocks in the market. Now, the tax implication for the corporate entities, that there is a double taxation. Okay, first is every corporation, when it comes to their net income, that is subject to income tax, and second, when the net income is transferred to the owners or to the shareholders by way of declaring dividends, there's another tax that it will be imposed, that is 10% of that. So there's a double taxation. That's why it would be a disadvantage for the shareholders to have dividends in that way. However, well, since considering also the potential of the corporation in creating the value of the stockholders' investments, so might be the double taxation might be overcome. Okay, it's like that the benefits will be more than the cost. The cost is one of that is the taxes. Now, for instance, the corporation earns 5 per share before taxes. So the tax is 40%. So it has to be the tax of 40%, that is like two of this one will be deducted. So the net of per share earnings is 3. Now, once that it is distributed to the personal account of the investors or shareholders, there's another 15% that will be deducted of that. So imagine how much is the net pay that will be received. So in here, the what they call this one. So first is 5 to leave in the 3. Then second, you will pay 3 times 2 equals to 0.45 taxes for an added dividend. So that's why what will you receive is only 2.55 from the original 5. So that's it. So commonly the corporation is subject to dividends tax, but in the sole corporation or the S corporation, the owner of this one, whatever the profit that is transferred from the S corporation to their personal earnings, are not subject to dividends tax. However, those amount of money that they receive from from the sole corporation will be part of their separate personal earnings, which will be taxable in their personal capacity. So there in that way, there is still another tax that will be, that's a double tax in effect. So to demonstrate the difference between the regular corporation and the S corporation example, um, here there's a 5 before tax. So if the corporation is 0 in tax, so the personal tax rate is 30%. So in that way, since the corporation is not subject to tax, whatever is the earnings from that corporation will be transferred to the personal capacity of the investor. So it will be subject to the 30% of the personal tax rate of the investor in his personal tax. So this is why after receiving the 5, there's a 1.5, and it will be taxed automatically, and the net amount is 3.5. In the previous one, in the regular corporation, if that is subject to tax, um, it looks like the 1.5 taxes that you pay is substantially lower than the 2.5 in our previous example, because it was taxed twice. However, we have to remember that for the C corporation, there will be no tax for the dividends if there's no transfer of the amount to the investors or the shareholders. However, for the S corporation, once that there is a declared net income coming from the sole corporation, it is automatically be presumed to be part of the earnings of the owner of that sole corporation. So meaning to say, regardless if there are transfer of funds from the sole corporation or not, there will be tax automatically.